good morning, everyone. It's very exciting to be here. And I can't thank Indian Chambers of Commerce and Kerala Startup Mission for organizing this. This is a very important topic, something very close to my heart. But a quick word of introduction. Name is Abhinav. I work as a partner with Deloitte. I have been in consulting for quite a few years, but prior to that, used to be in banking. In my last role, I was heading the data and analytics for Citibank Japan, based out of Tokyo. So some of the examples today that we'll be talking about are global practices as well, the best practices sharing from across the globe. Let me get started by saying that, we are going through the biggest transformation in the financial services industry today. And when I say that, think of fintechs. Fintechs are here to revolutionize the way financial services are delivered to customers and clients by banks. Now, if you think of fintechs, right, we would hear words, and we have been hearing that, crowdfunding, peer-to-peer lending, bots, robo-advisors, and, algo traders, and all of those. So it is this plus a lot of other things. The way that we would define fintech is a financial technology that streamlines, that augments, that would probably design and disrupt the way financial services are delivered. But interestingly, let me rewind back a little again, right? Before we get into the nuts and bolts of fintech and big data and what's its impact, let us rewind back and look at the reasons for this fintech to exist, right? The whys of the fintech. And what I would do is I would take you back to the year 2008. Banks typically and financial institutions were very good at embracing technology, adopting technology to better their services to the customers. Now, it might sound prehistoric right now when I talk about machines that accept cash deposits or ATMs for that matter. But in those days, this was a revolutionary technology. And it doesn't come as a surprise to me if you ask me as to why were banks embracing technology. It's a very competitive landscape where banks and financial institutions operate out of. And within this space, technology is probably the only lever that helps them scale up their business, that helps them drive this efficiency from a customer engagement perspective. So they were good at technology, right? Now the story is that come 2008, and suddenly overnight the regulatory landscape changes. The rule book is thrown out of the window. There's a quantum shift in terms of how regulatory reporting was being done versus what is asked of the banks right now. And this was also the time. So what happened essentially? The focus from the customers suddenly shifted from customers to the regulatory side of the spectrum, right? And banks lost out that game there somewhere in 2008. This was also the time, some of you would remember, people from my generation, this was also the time that the iPhones of the world were being launched. The Ubers of the world, the Airbnbs of the world, the Amazons of the world were being launched. And what happened there? This was not just a product or a service that was launched in the market for consumers to use. This revolutionized the way that people thought about shopping. Amazon changed that. Uber changed the way that people thought about the experience of booking taxi, the experience of booking hotels. So if we try and understand what really happened, right? Banks on one side lost the focus of customers. The focus shifted from customers to elsewhere. And at the same time, customers were, to the extent I would use the word pampered, by some of these other technological firms, which revolutionized the delivery and the experience that customers had. While, like I said, booking taxis or anything, all the Swiggies and the Zomatos of the world included. Now, this created a gap. What was this gap? This was the gap in terms of what the customers expected out of institutions that they deal with versus what the institutions were offering the customers, especially the financial institutions. This gap was so huge that non-traditional players like technology firms, fintechs, startups, they started coming in and started providing this value to the customers to fill this gap up. For example, I mean, Facebook, if you look at Facebook, they have probably 50 regulatory licenses in US alone. Amazon experimented with student loans on its platform. I was speaking with my friend Vijay yesterday from Amazon, and he's going to tell you more about Amazon Pay and how things have evolved there. Now, what exactly happened? These are technology firms. They were not in the space of banking and financing. But because of this gap created of the 2008 type of an era, these things kind of came in. Let me also talk a little bit about what is going to happen if things continue the way that they are going, right? Banks would be left to take care of, I mean, don't quote me, but the boring, the back end, the reconciliation, the settlement, right? The regulatory reporting, those are the things that bank would start doing. It would become a commoditized utility provider versus the newcomers will have a choice to pick up the juiciest part of this banking spectrum, which is, I mean, no prizes for guessing, it's the most profitable part as well, which is the customer interface, right? And that is where these companies are going to get into. Now, let's talk a little bit about the advantages of fintech. Of course, we have the cost efficiency play. We have lesser cost, we have efficiency because of competition. But the biggest thing that they have done is to encompass the non-bankable population. In my language, we used to call it thin file customers, who don't have enough history, who don't have enough transaction history with the banks. 2 billion people today are non-banked. They are not under the aegis of an organized banking sector. So fintech has done that. I would say the one word to remember here from a fintech perspective is access. Access to organized banking is something that they have brought to the table, other than the 15,000 other things which they have done well. Also, like I was saying, if you think about what would bankers look like in future, right? So we had a traditional, if you think of a banker, you would think of certain adjectives associated with a banker. What would the banker of our future look like, right? They would not only come up with different skill sets, they will have a different personality. They would come with very different backgrounds. They would come with very different mindsets. It would not be surprising to see, and I have been in banks myself, in Citibank Japan, we used to use Foxpro at that time. So you can imagine technologists taking up the banker's job, right? That's the quantum shift here that we're talking about. Think of a 10-year-old girl today. Some of us have daughters here and sons. Where do you think they are going to open their first bank account as they become adults? I'm pretty sure it is not going to be a traditional bank. It is going to be with a fintech. It is going to be with a technology company. Also, if I talk about a little bit from a customer perspective, right? Think of banks, the way that they look at a customer. Gone are the days when your account statement represents who you are. I withdrew 200 rupees or 2,000 rupees from this ATM at that time. I spent my money in this credit card, so on and so forth, right? And even that is a challenge because there are 15 lenses through which a bank looks at a customer. They are not tied to one another. We might think here that if I've taken a mortgage loan from a bank and I have a credit card with the same bank and have a fixed deposit with the same bank, they are going to kind of reconcile all this data together and they have one picture of me as a customer. But that is so not true. So what is happening is account statements don't represent who we are. We have our own belief system. We have our online searches, the type of online searches we do, the social media profile that we have. So somewhere what is happening is that all of this needs to get together, and that is where big data kind of comes in. And to a large extent, it is not just an account statement like I was saying. It is way beyond that. So banks today and financial institutions are struggling to pepper this account statement or transactional information that they have of you with all the other information about that customer from different sources. And all these sources needs to converge together to build the synergy which the banks need. Now, having said that, let's talk about what's driving this fintech. And I would go to the extent of saying it is the millennial generation to a large extent. People of my generation, we have seen the other side of the banking spectrum as well. So we are used to that to some extent, right? But if you think about the millennial generation, some research happened where they said that 66% of millennials say that I want my financial institution to predict what I'm going to need in future. I mean, some of you might appreciate it. People of my generation and older get irritated by the fact that why on earth do you know? If I've searched something on Amazon or Flipkart and I go to my Google or YouTube, suddenly that pops up. And I think my privacy is being breached somewhere. But having said that, the new generation or the millennials, as we speak about them, they want that to happen. Another survey happened, they said that you want to go to a bank or you want to go to a dentist. 70% of them said, I want to go to a dentist and not a bank. Now, this is a wake-up call for bankers, right? It's not a pleasurable experience. While shopping is pleasurable on, let's say, some of these online platforms, while booking a taxi, while getting food delivered to your home is a pleasurable experience. This is not pleasurable. And the dreaded token system in the bank, number 23, and you keep looking at the counter tick when 23 is going to come up. So I would say to a large extent, the millennials are driving that, but all this data convergence which needs to happen, that is of crucial importance. And that brings me to this good segue of talking a little bit about big data. I'm not going to spend a lot of time on big data, but what is it essentially? What do we mean when we say big data? They say that when you're in London, you should smile more often. That's what I read a month back. Essentially, I understood that a typical Londoner, when he goes about his daily chores, he is photographed 600 times a day. And these photographs are supposed to be kept for at least 5 years. Now, I'm talking about the volume of data that is getting generated. All of us have smartphones here. I mean, take a guess in terms of how much data is it generating right now when you have not even touched your smartphone. It's lying in your pocket. So what? I mean, there are mind-boggling numbers. 4 lakh, I will throw some numbers at you. There are 4 lakh hours of Netflix watched each minute. There is 200 million emails sent out each minute. 4.1 crore WhatsApp messages sent out each minute, right? It's crazy, 4.5 million YouTube videos watched each minute. Numbers are mind-boggling in terms of how much data is getting generated. So it's not just about the volume of data, it is about the velocity at which it is generated. Now, what qualifies as big data? For some of you who are not aware, we use the 5V principle. Volume is 1, the amount of data getting generated. Second is the velocity or the speed at which it is getting generated. Third is the variety of data. When we say variety, it is structured data, it can be unstructured data, it can be semi-structured data. Structured examples are like, think of an Excel sheet, right, which we are all fond of. So Excel sheet is structured. Unstructured, a semi-structured data would be, let's say, a commercial loan document in a PDF form. It can be, there's a lot of information, but it's not structured in the way that we are used to seeing it. And the third is unstructured, which can be an X-ray report. Unless one of you is a radiologist here, it's very difficult to make sense out of it, right? But there's a lot of information in that as well. Now, while we are on this big data subject, I would leave you with probably a few other examples as well. Think of what fintechs are doing, right from crowdfunding and peer-to-peer lending. There are organizations which are connecting fintechs with wearables, right? So if both of us have a same car and we belong to the same demographic profile, both of us end up paying exactly the same premium. I might be a way worse driver than you are, right? So you should be paying way lesser premium than I am. But that is what some of these fintechs are trying to do. Now, coming to this big data side, I will talk about probably 4 points here, right? First point, we need to, and some of you are startups here and fintech professionals, so I would like to bounce off some ideas from you as well. But first point is moving from the relationship database, the ETL, right, the traditional ETLs, to more of data streamlining. The speed at which all this data can come to me as a financial institution, for me to make sense out of it, for me to develop insights out of it, and make sure that it is implemented so that the customers can see the value. The customer experience kind of goes northwards, right? So moving that streamlining is very important. And going from this ETL to a NoSQL kind of an environment, we have many examples, right? You have this document database like MongoDB, which is used by Ubers of the world. You have this GraphSQL databases, which is Neo4j that is used by the Walmarts of the world. You have Cassandra's used by the Netflixes of the world. Redis, which is a key value database used by the Twitters of the world. So I'm not going to bore you with detail here, but essentially what I'm saying is that mindset shift is very important. Moving from just collection of the data to a data being in a form and a shape that we can tweak it. We can work with it to come up with useful insights. Right? So from a 5V perspective, we spoke about the volume, the velocity, the variety of data, the veracity, which is basically the accuracy and the trustworthiness of data, and finally the value, which is the insights. I mean, all this data is useless unless I can interpret it in the way that I understand and I can implement those insights so as to see my customer experience get better, so as to see my efficiencies become better. So first point, ETL to the NoSQL type of an environment. The second I would say is more from a cloud migration point of view. And all of you here would appreciate that. Not a lot of us have very deep pockets, especially people who are starting fintechs, who are getting into startups. So this is a very obvious answer, right? From an access perspective, from a cost efficiency play perspective. But more importantly, it gives you that scalability, right? But again, I think somebody on the dais mentioned that there is a lot of regulatory nuances here from a cloud migration. Why at the time that we would like to shift everything up on the cloud there from an efficiency play point of view, but at the same time, the bankers have written to RBI asking for more clarification around what can and cannot sit on-prem versus on cloud. So we have to be careful there. Third, I would say, is data monetization and data democratization rather. Now, data democratization, what does that mean? The right data in the right format is available to the right decision maker at the right time. There are a lot of rights in that statement, but basically what I'm trying to say is it needs to be accessible to everyone in an organizational chain. But here, we run into problems like data governance and access. Who can access what part of the data? Not everything should be accessed by everyone, right? That's where data security, data governance kind of comes into the play. The fourth one that I would talk about after data democratization, and here I would like you to use a bit of your imagination, right? So this is the adoption of data science. And when I say data science, the imagination that I'm asking you to do is, my right hand here, this circle that I'm drawing, this is business. On the left is technology. They overlap and they result in something which we call as IT, right? Now, scope cannot be changed. 6 months down the SDLC life cycle, we cannot say that, well, the scope has shifted. So it's not very agile, right? Business and technology. Now throw in applied mathematics or statistics as we call it. Business and applied mathematics like statistics, this circle here, the Venn diagram will give rise to frameworks. Now frameworks can get obsolete very fast. So what used to be a good framework for us to consider in the 2000s, it's not applicable anymore. And the third side of the story is, which is the most interesting, technology talking to applied mathematics like statistics, and they give rise to point solutions, like the Zomatos, the Dunzos, the Airbnbs, whatever, right? Now, point solutions are not scalable. They are solving a very specific niche problem for the customer. But are they kind of expanding? The play of these three circles, business, technology, and applied mathematics, the common intersection of these three circles is where we find data science. So some of these technology firms that you're hearing about, when they start graduating to data science and leveraging data science to use in their daily day-to-day decision making, that is when magic happens. That is when they can expand from, an Uber can expand from a taxi service to a Uber Eats, right? So this is what I would leave you from a big data perspective. Now talking about, I will just spend a few more minutes talking about the major use cases, the top 4 or 5 use cases from a big data and fintech perspective. What I leave out for those of you who are emotionally connected to crowdfunding and peer-to-peer lending, so please excuse me, but I'll talk about the top 3 or 4 which is really shifting the needle for all of us in this financial services space. The first one I would say is from a fraud prevention point of view. It can be identity theft, it can be a credit card scheme. Now for me, for someone like me, I go to Singapore, I swipe my credit card to buy a lady's handbag. They automatically, it's a rule-based system, they automatically detect that, well, Abhinav is not someone who buys lady's handbag at Singapore, let that transaction not go through. Now while I am irritated here standing in Singapore airport that my transaction is not going through, but some other gentleman is sitting happily in Kochi and his card is getting swiped in Singapore and he is very happy that the bank stopped that transaction. Now this balance between these two customers is what we are trying to get to, and that happens by the magic of, let's say, dynamic Bayesian rather than a rule-based mechanism, running random forest for some of you who are familiar with this, right? The second I would say is more from an anomaly detection perspective. Now anomaly detection is not about prevention of something. It is about identifying an anomaly in the banking transaction and doing a double click and investigation on that further. One good example for that would be, let's say, insider trading. So before and after a non-public information is kind of let out by an organization, how many people in that organization are making trades of what nature, the frequency of trades, how many times are they doing it, what's the volume of the trade that they're doing it, and we can figure out that, right? Now the ways to do it again is to not irritate an employee who's actually not doing insider trading. He just happened to kind of make a purchase or a transaction on the stock market. The way to do that is recurrent neural networks. We have long short-term memory models to kind of do that. And we have implemented some of that in Deloitte as well, in my firm. And I would love to talk to anyone here who's interested in kind of doing a double click in this space. Final couple of examples. One I would say is more from a customer analytics perspective. So customer analytics is probably the thick of it, right? It's the main, I would say the meat on the bone, right? So what happens is, there is hyper-personalization of a customer that is happening. I don't want to be put in a particular segment and the entire segment is dealt in a particular way. I want to be treated as an individual, and that is where we talk about hyper-personalization in the banking space. So many unsupervised and supervised machine learning models kind of do this personalization for customers. We have done that in Deloitte as well. Another example was a national bank made an acquisition, and with that acquisition came thousands and thousands of commercial loan documents. And for those of you who have been in the wholesale lending practice, or you understand the nuance of it, you would appreciate that the two documents can be chalk and cheese. They're very different in terms of format. A bank A lending to a client A versus a client B, they are prepared by lawyers. These PDFs can be very mind-bogglingly difficult and different. Now, having said that, we have a tool called DICE, D-I-C-E, which is basically a natural language processing solution that we have. It has OCR to pick up the right words from that document, use RPA to kind of make a seamless data entry. So these are some of the examples. Final one that I would talk about is more from a algo trading point of view. Now, when we say algorithmic trading, what it essentially means is some of you would be buying and selling stocks. You have a model, somewhere a subconscious model is there, especially for traders. They know when to buy and sell, but there is an inherent human hesitation in doing something. And algo trades, what they do is they kind of take that hesitation away very quickly. And while the trader can only concentrate on one stock at a given time, in a given market, there can be thousands of these algo trades running parallelly, taking advantage of all the arbitrage opportunities which are out there in the market. But slowly that margin is kind of shrinking because a lot of players a lot of fund houses have introduced that. But I would probably close by saying that, is it a fad? Is fintech a fad? In my personal opinion, I really don't think so. We might see a lot of changes, like I was saying. A 10-year-old girl might open a first banking account in a completely different place, not traditional banks as we know of. But pure digital banks would come up, right? No brick and mortar, no branch presence at all. My father still likes to go to a branch and take a coupon. He loves doing that. A 20,000 rupees transfer to be made, and he would love to go to a branch and do that. And I've told him 1,000 times probably you can do it online. He still doesn't trust that. So I don't blame that generation. But for me, if I have to make a huge transfer, I would also probably do the same. The difference between me and him is probably just the volume of transaction. But the new generation, they look at world in a very different way. So we will have new banks. We will have credit cards as an experience product rather than something which is a transactional product in my wallet, sit in my wallet. And finally, I would say that fintechs are here to stay. What we will see is not a bank versus a fintech story. We will see a lot of consolidation and collaboration that will happen between financial institutions and fintech. Thank you once again. You have been a wonderful audience, and I'm looking forward to learning more from each one of you today. Thank you.